So this topic in this chapter, which is foreign exchange derivatives, forward, futures, options, and currency swap, we have talked about foreign exchange risk, how the rates are quoted, and different theories of determining those exchange rates. Now, what is important to understand is that how to use foreign exchange products to manage and protect your risk. Okay, and that's where this topic becomes important. So this topic in this chapter is about foreign exchange derivative, foreign exchange products. As we have already introduced derivative at length, and I've discussed that in our chapter on derivatives. So we'll have in certain cases in certain products, since we have already introduced them, so we'll have a passing remark. We'll only see the application or the add-ons that probably comes up with the currency as a underlying. Okay, all of the concept of trading derivative would remain same. Concept of derivative would remain same. The definition of derivative would remain same. That these are instruments which does not have its own value, would derive its value from some other event, some other underlying. Okay, so in this case the underlying is currency. So we have currency forwards, we have currency futures, we have currency options, and we have currency swaps that people could use to help trade in this market, to protect their risk, to manage their risk. Okay, so from that point of view we are going to discuss this topic, and among all the topics the forward becomes more important, as this is still over the counter market in trading currency, especially with merchandise trades of export import. Okay, you have a lot of applications of forward contracts happening in the market. Okay, so let's try and see this topic. Now what we are talking of is that what does this product help you to do? Okay, these products of foreign exchange derivatives, what does it help to do? Okay, it helps you in managing your risk. Okay, in taking care of your risk. So what is the risk that is involved in foreign exchange transactions? Okay, so when we generally see, okay, if we see in any day-to-day activity, there is always a kind of a time gap, okay, between any international business or any financial activity that the firm does, or if there is a sale purchase happening which is dealing with foreign exchange, foreign currencies. So such type of an activity would, by the time you actually enter into some kind of an agreement or execute those trades, okay, there is always a chance that the exchange rate could fluctuate. Okay, so it has been observed of late that exchange rate has become very volatile, and that's why this element of risk on account of adverse movement of exchange rate is there. Okay, so what we are talking in this case is, suppose you are an exporter and you are sending a consignment to US. Now your terms of trade said that the consignment after reaching US, okay, would be eligible for payment. Okay, so you send your consignment, and the transit or the usance period involved before actually you can raise the bill is supposed to be a month. So when you sent your consignment from India as an exporter to US, the rupee dollar rates was something, suppose it was 58. Okay, now by the time your payment becomes due, okay, after a month or so, the rate could change. So there is always a time gap in different transactions and different terms and different situations that might happen. Okay, so that is what we're trying to understand. So when you sent your consignment, the rate to a dollar was 58. Now when actually your payment is happening, maybe the rupee becomes stronger, it becomes 55 to a dollar. So you actually only receive 55 per dollar. Okay, and that's where your risk is as an exporter, that you would have otherwise got 58 rupees a dollar had you been in a position to get the payment done when the consignment was sent. Okay, similarly if you're an importer, so then for you the risk is of rupee becoming weak. That means when you imported, the rate to a dollar was 58. By the time the consignment reached you and you came forward to make the payment to the bill that was raised by the importer, the exporter, and you being an importer in India, maybe the rupee has gone weak. So now it's 60 rupees to a dollar. Okay, or 60 rupees to a dollar. So now you have to pay more against every dollar to fulfill your commitment. So that is the type of risk that we're talking, that there is always a kind of a time gap between situations, between transactions, between business dealing, between activities, and this time gap, the waiting period, the time that you wait to actually make the payment is where you're exposing yourself to the risk of foreign exchange fluctuation. Okay, so foreign exchange risk is defined as the possibility of adverse movement in foreign exchange rates. Okay, so if there is a high possibility of rate becoming adversely moving, so when we say adverse movement, we're talking from the point of view of people who are doing a trade. Okay, so if you are an importer, the adverse movement for you is when rupee becomes weak, okay, to a dollar. So today you might be paying 60, tomorrow if it goes 62, you have to pay more. But if you're an importer, okay, if you're an exporter, then for you the risk is of rupee becoming strong. So you would have got 60, the rupee went strong, became 58, 57, 56. Now you're getting a very lesser amount of rupees as compared to every dollar that you're sending. Okay, the consignment that you're sending worth in dollars. So that is what we're talking of. Okay, we're talking of the risk that is exposed because of you waiting for a transaction to get complete. Okay, and that is what is defined as the foreign exchange risk. The possibility of adverse movement in foreign exchange rate is what is defined as a foreign exchange risk. Okay, what are the foreign exchange risk management would basically be then a process of managing such risks. So it's one of the most important activity which is done through treasuries, which tries to reduce and eliminate the risk, so that the result on any adverse movement on foreign exchange rate is minimum as compared to, okay, if otherwise you're not protected and not hedged. So there are 5 important techniques or important tools which is used to manage exchange rate risk when we talk of foreign exchange risk. So you can use forward contracts to manage your risk, you can use futures contract to manage your risk, you can use options contract to manage your risk, you can use currency swaps to get benefit by entering into some kind of understanding with different participants with involvement of intermediary in between. And then there is the money market operations which can be used to protect that risk. So end of the day, what you're trying to do is you're trying to hedge the risk. Okay, and hedging as a process is always a mechanism to make your risk zero. Okay, and we have discussed that at length, that there is no other thumb rule than to probably follow a rule which said that whatever you're going to do in cash market in coming days, okay, in spot market in coming days, you do the same, but instead of doing in spot, do it in derivatives market. So suppose as an exporter, you send a consignment to US, okay, and it took a month for the consignment to reach US. You sent a consignment of garments worth $1 million, okay, to US, and it took a month for reaching, and then the payment was supposed to be made. So what you're going to do, you're going to sell those dollars to get rupees. So when the payment would come in dollars, okay, in your account, you will be getting rupees. Okay, so you're going to sell dollars and then you're going to take rupees to sell dollars, but not the spot dollars. Go and sell 1 month forward dollars. Okay, and that is the mechanism that would help you to protect your risk. Okay, same process, same thumb rule, what we have understood when we introduced derivatives, and we talked about derivative as a product which can be used for hedging. So when you're talking about forward contract, you go to a bank and you deal with a bank and enter into a forward contract on what you're going to do in incoming days. So as an exporter, if you're supposed to sell dollars, you go and sell forward contracts. If as an importer you're supposed to buy dollars, you go and buy a forward contract. Okay, if not forward, you can do the same over exchange, so that it becomes a futures contract. So any derivative contract which is obligatory on both the party, but traded in standardized form on exchange, is what we say is futures contract, and that is where the futures and forwards were different. We understood that at length as well. And if there is a right without obligation to the buyer of a contract, then we have called them for options contract. So the third product that we see here is an options contract, and then there could be a currency swap wherein there could be 2 parties involved, where the intermediary comes into the picture to give benefit to both the parties. So there could be one party who is having say a US firm who has taken a Japanese yen loan, and the interest and amount has to be paid in yen. Okay, wherein there's a Japanese firm which has taken a US dollar loan from a US bank, and it has to pay the interest and principal in US dollars. So they can then enter into some kind of understanding wherein the obligations can be swapped. Okay, so that is what is a currency swap. And then there is a money market operation, which is also very effectively used in this market to protect your risk. Okay, so any mechanism that can minimize the risk that would happen because of fluctuation in exchange rate risk is what we say is the process or the mechanism of risk management in this market. Okay, so the same concept of managing risk, the same concept of using derivative, the only difference is that we are talking of from the point of view of currency being an underlying now. Okay, so let's try and take the first product, forward exchange contract. The forward exchange contract is a contract wherein out of the 2 parties, now in Indian context, one party compulsorily has to be a bank. Okay, So bank could be one party, and then the other party could be the customer of a bank, could be a bank with a bank, could be a bank with an overseas bank, but then one party to a forward exchange contract will always be a bank in Indian context. So this one party agrees to deliver a certain amount of foreign exchange, currency at an agreed price, okay, for a fixed future date. So when you approach a bank, being an importer, being an exporter, suppose, so you send your consignment to US and you are an exporter and you foresee that the consignment is going to reach you in a month's time and your payment will be due after that. So you approach a bank, okay, and you enter into a forward sell contract, okay. So when you enter into a forward sell contract, the bank is actually committing to giving you $1 at a decided rate today. So today itself it's going to give you $1, and we already discussed the forward rate quotation that could be at premium, could be at discount. So depending upon the interest rate differential prevailing in the system, prevailing in the economy, you see the rates quoted by the bank. So you know that whatever now happens with the exchange rate fluctuation, okay, your rate is fixed. So supposing if the spot was 58 and you get a premium of $1, suppose, and you could fix your rate of 59. So whatever happens to exchange rate, okay, going further, whether dollar rupee becomes strong or weak, you are going to get at 59 rupees to $1. Okay, so that is what happens in a forward exchange contract, and both the parties are under obligation. Both the parties are under obligation to fulfill the rights. Okay, one party is a bank. So bank, with bank, a customer can do a forward purchase, can do a forward sell. Okay, a bank could enter with another bank into an interbank market dealings, or a bank could enter with an overseas bank to, okay, take care of requirement of international exposures. So such type of transaction is what we talk of when we say it's a forward exchange contract. Okay, so the dates are determined today, the rates are determined today. At which date you are going to exercise your obligation is again determined today. So you have a fixed future date and you have a rate which is agreed, quoted at that point in time for the amount also. So in this case, since it's a customized contract, okay, you also need to quote how many, okay, the amount of foreign exchange. So whether it's a $50,000 or whether it's a $1 million, sorry, $1 lakh. So depending upon your transactions also. Okay, so that is one thing. The other requirement while dealing in forward exchange contracts are the currency of cover. Okay, now there are some restrictions, there are some regulations, there are some rules which probably would prohibit you from doing something other than that. That if a trade transaction is for which you want to take up a forward contract, it can only be booked on a specific order or letter of credit or on sales contract. Okay, that means you have to give some kind of a proof that if you are an exporter, you send a consignment, you're expecting a payment to happen in 30 days time. The bank has to be given some documents to show that this particular consignment is on way. Okay, and because of that exposure, you want to cover your risk. So it can't be that anyone who wants and you can take up a contract. Otherwise, then there is an exchange. You can go to take up a forward futures contract instead of taking forward forward contract which is offered by bank. Okay. Now the currency of this contract should be the currency in which the cash flow is going to is expected. That means if you are sending a consignment to US, then you can only take up a forward contract in dollars. Okay, you cannot probably take up a contract in euro or in yen. Okay, so that is one restriction. Again, the customer cannot exceed the amount of this cash flow. That means if your consignment on your letter of credit, on a sales contract, on documentation that you have produced to your bank, if the consignment is worth for $1 million, okay, then you cannot take up a forward contract in value terms more than $1 million. Okay, so that is what are some prohibitions, some restrictions, that you can only take up a currency of cover, which is the currency in which you are doing a transaction, in which you are expecting a cash flow to happen, and this amount, this total value of forward contract cannot exceed the total cash flow that you are expecting. Okay, however, if you want, you can do you can enter into a forward contract on a part or whole amount of the underlying order. Okay, so if your order was for $1 million, maximum is 1 million that you can go, and if you want, you can take 5 lakh, 6 lakh, 8 lakh worth of contract, because then you are taking some under hedge. Okay, maybe you felt like covering it yourself some portion and only want to cover some amount or some part of it as a hedge, as a cover. Okay, but you cannot exceed, you cannot probably take up a contract of 2 million if your order size is only of a $1 million. Okay, so that is some restrictions. Similarly, the exchange control requirements in case of forward contract or forward exchange contract is that the forward contract facility is available if the party is exposed to genuine risk on account of exchange rate movement. So as per RBI's monetary policy, any resident individual can only book forward contracts okay, without production of documentation, underlying documentation, documents and all, up to a limit. Okay, that limit could keep on changing, but as of now it's a lakh of dollar. Okay. So if it's more than that, then you have to produce documents to probably take that contract. Okay. Now contracts on forward purchase or sale of any foreign currency can be entered only if it's into a permitted currency. So not all currency you got a forward contracts available in the market, and the exporters and importers in India can book forward contract only with those banks which are authorized, okay, to deal in foreign currency. We call them authorized dealers. So not all banks again would be allowed by RBI to deal into foreign currency market. So these are some limitations, and the banks can only undertake interbank transactions okay, for conversion of one foreign currency against another currency with a bank in India or with a bank overseas in market, or for covering of customer or operational requirements. So that these rules, these concepts are there. That means there is always some mechanism, some system, some okay requirement for under which this market will be governed. Okay, so these are some exchange control requirements. Further to it, as an ingredient to a forward contract, there are certain furthermore requirement, in the sense that the contract amount in forward exchange contract have to be for a definite amount. Okay, the amount of the forward contract is expressed in foreign currency. An equivalent rupee has to be rounded off. Okay, the rounded off mechanism is where the exchange rate quotation comes into picture, and we talked about pip and point quotation and how much, to what extent can the rate be rounded off, and those mechanism of buying low and selling high if your rates are quoted directly. So those things should come into observation, but then there has to be a definite amount and fixed rates expressed in foreign currency. And the parties to a contract, there would always be two parties to a forward contract. Out of these two parties, one has to be a bank. So it can be two banks, can be a merchant of a customer and a bank. It can be a Bank of India and a bank which is overseas. And the rate of exchange at which the sales or purchase of foreign exchange should be made also has to be mentioned. So you have to give a quotation, whether it's a forward contract or a spot rate. You have to give a quotation. So that's where all the arithmetics, all the mechanism of working out on forward contract would come handy. Okay, so these were some requirements apart from what we understood as forward derivatives, and how are they different from the futures contract. And we understood at length that predominantly the only way we could probably classify them to be different from futures are when it's customized, over the counter traded, one-on-one. So that is where this requirement, this restriction, this ingredients of forward contract would come handy. Okay, so you know that it has to be vis-a-vis bank. So if you are a customer, you have to take the contract with a bank. The bank can take with another bank, with an overseas bank. Okay, and the amount has to be specific. The amount has to be finite. Okay, you need to define them, that it would be for $1 million, $2 million, $3 million. Okay. Any amount which is more than $1 lakh needs to have a documentation proof. Unless and until that is not provided, the contracts are not booked. And the rates has to be quoted. So while quoting the rate, the bank can use the arithmetics to round it off so that it can make the benefit or profit out of that. Okay. So these restrictions are there under which a forward contract would be taken into consideration. Okay. So let's try and take one example to understand this entire concept better. Okay, that what advantage do you get if you're considering a forward contract and hedging your risk against it, vis-a-vis whether you should be doing a no hedge situation. Okay, so let's take this example. So in this example, if you see, it's a case where there is a company which is considering hedging its foreign exchange risk. Now it has made a purchase on 1st of January 2008. Now this question has come in past exam, so we will take the value which was quoted at that time straight away from the question. So it has made a purchase. So there is a purchase transaction, okay, on 1st of January 2008, for which it has to make a payment. Now the payment is not due right now. So the payment, it has to make a payment of 50,000 USD on 30th of September 2008. So this is where there is a risk of foreign exchange fluctuation becoming adverse to you. That means when you purchased, okay, and you are making a payment after 9 months, there is always a risk. There is always a risk of rate fluctuating, and if it fluctuates adverse to your exposure, your requirement, then that is where foreign exchange risk lies. Okay. Now you have been given some present rates. Let me just try and change a color for that. The present exchange rate is a dollar equal to 40, and the rates which is quoted, that means he can purchase a forward contract or at 39 rupees to a dollar. Okay. So dollar is at a discount, and when would the dollar be at a discount? We already have discussed that in our previous topic in this chapter, that when the interest rate differential is in such a way that the interest rate in home currency is lower than the interest rate in foreign currency. So that's where you get interest rate when differential being passed on to you in the form of discount. So spot rates are 40, your forward rates are 39. Okay. The company will have to make an upfront premium of 2% of the forward amount purchased. So when the company is looking to that, the company will have to make an upfront premium of 2% for forward amount purchase. So there is a terms condition which says that you are purchasing $50,000. So out of that $50,000, you have to pay 2% of that. So $1,000 has to be paid upfront, and the cost of such kind of a funding is at 10% per annum. Okay. And the rate of corporate tax is given at 50%. You have also been asked to ignore taxation, so that would be irrelevant in that case. So there are two situations given. Okay, the situation that has been given is you have A and B. Okay, when the rates were different, that means on 30th of September the rate, if it becomes 42 and if it becomes 38, then what is the gain loss, profit loss that the company could make if it hedges or if it considers no hedging. Okay. So simple situation that you have purchased something 1st of January, you are supposed to make $50,000 payment 30th of September. So you have 9 months of time gap in which you don't know how the rates are going to fluctuate. The present rate is 40. The forward contract prevalent today is at 39 rupees to a dollar. If you take up a forward contract, you have to pay 2% upfront premium, for which the cost of fund would be at 10% per annum, and you have to tell whether the given situation, you have to compute the profit loss if on 30th of September rupee becomes weak, goes to 42 from current 40, or if it becomes strong, goes to 38 from current 40. Okay. So these are this situation. So let's try and do it in the sense that I'll evoke a whiteboard, and I appreciate we can do it together. Okay. So what we are doing is we are trying to work out under two cases. Okay. One is the profit or loss, okay, in rupees terms on account of hedge if the rate on maturity is rupees 42 to a dollar. Okay. So this is your first part that we are talking in this question. Okay. If it is 42 or to a dollar, then what will be the gain loss? Okay. So this is your A part that we are trying to answer. Okay. So let's try and see what would be the situation here, that if a company goes for no hedge, so the cost of no hedge, okay, or without hedge would be the rate that is prevailing at that time. So on 30th of September, okay, 2008, the rate is what we have seen here, 42 to a dollar. The rate is 42, okay, to a dollar. So if he has to make a payment, okay, so making a payment of USD, how much in this question? The payment was for 50,000. Okay, so USD 50,000 at 42 to a dollar, it becomes rupees how much? 42 into 50,000. Okay, so this is 21 lakhs. Okay, this is when you're doing no hedge, that is without hedge. Okay, now if you consider hedging, okay, comparable cost with hedge. Comparable cost with hedge, that means you are considering hedging. So what is the requirement? If you are hedging, then you have to pay a premium at 2%. Okay, so 2% of so the requirement here becomes you pay a premium. So let me just try and note them on points. So you make a upfront premium, okay, at 2% of $50,000. So that becomes $1,000 at, okay, now this is at the spot rate prevailing when you are entering into a forward contract. So when you are entering into a forward contract, it's 1st of January 2008. At that time the spot rate is $42. Okay, at spot rate of 1st Jan, okay, 2008, so which was $42. So you pay how much rupees? 40,000. Okay, this is one cost. Then since you have to get this funded, so your cost of fund is at 10% per annum. Okay, even if it's not that you pay from your pocket, it's always opportunity cost. So this cost of funding the premium. Okay, cost of funding the premium would be 40,000 rupees at 10%, so 0.10 for 9 months of 12. So it's per rate, the rates are per annum. So if you solve this, it comes to 9 divided by 12 into 0.1 into 40,000. So it is 3,000 rupees. So 3,000 is your cost of interest towards cost of funding. Okay, and then since you have entered into a forward contract, okay, if you enter into a forward contract, the rate that is committed to you is 39 to $1. Okay, so the payment on maturity that you will be making, the payment on maturity would be $50,000 at the forward rate. Okay, forward rate on 1st of Jan, okay, 2008, which is 39 to $1. So 50,000. So this comes to rupees how much? 50,000 into 39. So this is 19 lakhs 50,000. Okay, so if I add up all the cost, okay, so total cost with hedge, would be how much if I add them all? 19 lakh 50,000 plus 40, 19 lakh 90 and 3. So 19 lakh. So this is 19 lakh 93,000. Okay. Now this 19 lakh 93,000 if compared to the cost without hedge. Okay. This is your cost with hedge, and if I compare this with cost without hedge, which is 21 lakhs, you see there is a benefit. This value compared with this value, okay, there is a profit. Okay, because if you are hedging, your total cost, even if the rate becomes 42, okay, your committed rate is 39 that the bank has given at 1st of January, so you only pay 39. and that's where you pay a lesser amount. So in this case, the profit on account of hedge, profit on account of hedge will be a difference in this, which is equal to 1,07,000 rupees. Okay, so hedging in this case made sense, and every time, even if you're otherwise, if the rate goes otherwise, still you have to commit. So hedging is not for a process of making profit, but then if the rate goes adverse, okay, since you were someone who was supposed to pay and the rate went up, and you then would have been paying more. So if you're not hedging yourself, you're paying 21 lakhs. If you're hedging, including all the cost involved in mobilizing your premium at a cost of fund, it comes out to a benefit of 1 lakh or 1,07,000. Okay, so this is how you proceed. This is how you actually see the effect of hedge. So this was your first part. Now the second part is a separate situation, that what if the rate goes down. Okay, so again, if you are hedging, you will be committing to 39 to a dollar. So in that case, you might probably be in loss. Okay, so if you want, you can even check that. The second situation, when we see that the rate has gone down, we will try and find the profit loss. Okay, profit or loss in rupees on account of hedging. On account of hedging, if the rate on maturity is rupees 38 to a dollar. Okay, the B part of the question, rupees 38 to a dollar. Okay, so this is your B part. So again, the same process, the way we understood the first part, that if you are not hedging, so cost without hedge would be that you have to make a payment, the same thing that we did earlier, that on 30th of September, if the rate has become 38, you have to make a payment at 38. Okay, so cost without hedge would be the rate which is applicable on maturity. So you are paying payment of $50,000 at the rate which is prevailing, 38 to a dollar. So it comes to rupees. So cost without hedge would be rupees 50,000 into 38. Okay, so it comes to 19 lakhs. Okay, because you are entering into an agreement, you are not entering into an agreement, and when you are actually paying on 30th of September, this is the payment of 50,000 on 30th of September 2008. So the rate which is applicable at that time is what you have to pay. So rate at that time is 38 to a dollar, that is what you have to pay. Okay, now if you consider hedging, that means the comparable cost with hedge, with hedging would be similar to what we discussed in the earlier situation, that you have to be paying a premium, then you have to be paying cost for those funds, and there will be some final payment. Okay, so in this case, the premium would again be same. The premium is at the rate of 2%, okay, of $50,000. Okay, so it comes to $1,000, and since you are entering into a forward contract, so that is at 1st of Jan. So the rate which is applicable is 40. So this would then be similar to the premium cost would be rupees 40,000. Okay, at 40 to a dollar is what you consider paying. Then again, second part is similar, that you would be entering into a cost of funding for this premium, which is the same 3,000. So this would be cost of fund on premium would be 40,000 rupees into 10% for 9 out of 12 months, for okay, 9 months till September, rates are given per annum, so it comes to rupees 3000. The where it gets different is the third stage. Okay, if you see the earlier A part, the payment on maturity is at the rate which is prevailing at that time, the rate which is that you have entered into when you enter into a forward contract. So here you enter into a forward contract 39, so that is what would be applicable to you. Okay, so the payment that you will make, payment on maturity, okay, would be at the rate of 39 to a dollar your forward rates. Okay, the forward rate that you have entered, and we said that this rate is committed, communicated and obligatory on both. So in this case you will be paying $50,000 at 39 to a dollar, so it comes to rupees 19,50,000. So your total cost is same, that is rupees 19,93,000. and now when you compare this, cost with hedge and the cost without hedge, so you see that without hedge you are entering into some kind of a profit, okay, because the rate fluctuated. So in this case you are entering, if you see here, you are entering into some kind of a loss on account of, okay, on account of hedging. Since you hedge, so you enter into some kind of a loss in this case, because the rate that you enter would be obligatory in even in all cases, but then you are not sure how the price is going to fluctuate. Okay, and we said that the risk of foreign exchange is only if it fluctuates adverse to what you are exposed to. So in this case, since you are supposed to make a payment, if the rate goes high, the first example, you are setting up in a profit, okay, because you protected yourself by hedging. But if the rate goes down, you still being hedged, you have to be obligatory paying 19,93,000, wherein if you would have not hedged, you would have paying the market price, since the rate went stronger, so you pay 38 to a dollar. Okay, but then this is when you are not sure. Hedging is only applicable when you are not sure about the outcome of an event happening. So such type of questions have come in past, so be comfortable with this type of questions. Okay, the other natural type of phenomena for hedging could be when you do an exposure netting. Okay, so we talked about how hedging can be useful when we take forward contract into consideration, but then if there is a firm which is in a kind of a system or trading in which it's bound to receive some foreign currency and is bound to pay some foreign currency, is basically an export import kind of a mechanism, then they can net those transactions. So firm with receivables and payables in foreign currency can net out its exposure in the foreign currency and could match the receivables and payables. Okay, so such type of netting would reduce the foreign exchange risk exposure without any transaction cost, without any kind of a commission that you normally would pay to outside world, and that's why it's called referred as internal or a natural hedging. Okay, so like in earlier example we saw that you were supposed to pay $50,000. Now if you are in a kind of a situation as a firm who is even going to receive some dollars or some other foreign currencies, then that kind of an exposure can be netted. Okay, so that's another natural hedge, natural technique of hedging using forward contracts, or basically just negating the inflows and outflows, the receivables and payables, and then seeing what is your net obligation, and that net obligation can be protected using forward contract. Okay, so that is what is called exposure netting. You invariably in past exams have got some kind of a concept question explaining, wanting you to explain this concept as such. So it's appropriate to explain and then to probably bring some illustration to make it even understandable better. Okay, so let's try and take one illustration for that. Now if you see here, there is a British firm which is having following major transactions in next 2 months. So transactions during next 2 months is given for this firm. Okay, so one is that let me change color to identify the transactions on maturity. So the cash payment to creditors is due in 1 month, okay, for 120,000 British pound, and you are also going to have a cash receipt from foreign customers due in 1 month for $178,500. Now these transactions maturing in a month, transaction 1 and 2 can be netted, okay, because you are going to get some receivables, you are going to pay some receivables, you can being a British firm, okay, the home in home currency British pound, we can see the obligation which is netted, and accordingly that can be protected. Okay, wherein the other two maturing transactions, okay, the one is purchase of machinery, cash payment due in 2 months for $5 lakh, and dividend income that you're going to get as a cash receipt in 2 months of $1 lakh. Now this straight away can be netted, okay, again, and that is what we're talking, that these transactions, since you're going to get something, you're going to pay something, so you can include it to be netted in your obligation, and then see what is the net obligation and whether you want to protect that by hedging or not. Okay, so the spot rate's been given in this question. You have been given some more information. There is a spot rate of 1 British pound is in dollars given, buy low sell high rates. You have been given 1 month forward swap points, and you have been given 2 months forward differentials. Okay, the firm uses forward to hedge against foreign exchange risk. So calculate the net sterling British pound receipts and payments that the firm might expect, okay, for both its first month and second month transactions. So whatever is netted obligation is where the firm would want to protect itself by using forward contract. Okay, so let's try and see how to proceed with this. So 1 month transaction, if I want to see 1 month transactions. Now what is the rate which is given here? You have been given spot. 1 British pound is 1.5000, 1.5050. Okay, so these rates have been given. So spot rate of 1 British pound sterling is equal to 1.5000 and 1.5050 dollars. Okay, this is a buy rate is 1.500, sell rate is 1.5050. Okay, and you have 1 month forward. Now in this example, if you see that buy is high and sell is low, so this is a discount. Okay, we understood that when we talked about quotation, that when would a rate be a discount or at premium. The common observation is to see what is the interest rate differential. If the interest rate in home currency is higher as compared to interest rate in foreign currency, then it would be at a discount, and otherwise it would be at a premium. Okay, so here, since the buy margins are lesser, are higher as compared to sell margins, so so we can find an outright rate. Okay, so 1 month forward 1 British pound is equal to 1.5000 less 0.0060, so it comes to 1.4940. okay, and 1.5050 in which you are subtracting $0.0050 dollars, so it comes to $1.5000 dollars. Okay, now since in this case the bank is selling dollars, because if you see the transaction, the cash payment is supposed to happen, the cash receipt for foreign customer is due in 1 month. So as a customer you are going to give dollars, so bank would be okay. So in this case, since the transaction is sell, okay, we understood that the transaction in this market is referred from the bank's point of view, so whether the bank is buying or the bank is selling. Okay, so the bank is selling British pound because it's going to take dollars and give British pound. Okay, so the rate that is applicable hence the applicable rate would be your sell rate. Okay, sell rate in this case is forward 1 month is 1.5000. Okay, so the applicable rate would be this rate is 1 British pound is equal to 1.5000 dollars. Okay, now this is the rate that is applicable. So if we see the net payment that would happen after a net payment and receipt that would happen in 1 month's time. So net payment or receipts. Okay, in British pound after 1 month. So what is that? You have two obligations. If you see the question, the obligation is that you are going to pay, the cash payment to creditor is going to happen for 1,20,000 British pound. Okay, so to pay, your obligation is 1,20,000, okay, British pounds, and second one is that you receive by selling, okay, how many dollars? Since you're going to get some receipts from foreign customer due in 1 month, we're talking of this transaction, $178,500. So you'll set up the forward rate that time. So $178,500 forward. Okay, so that would be 178,500 divided by 1.5000, the rate that is applicable. Since British pound is a stronger currency than dollar, so we will divide it to find the cross rates. So it comes to, in pounds terms, 1,19,000 British pounds. So the net payable, okay, so the net payable in this case would be the net payable would be 1 minus 2, so that would be 1,20,000 British pound minus 1,19,000 British pounds, so it comes to 1 lakh. And this is what, if you want, you can protect yourself, you can hedge yourself. Okay, so this is the exposure that is netted, and then you have all invariably reduced your exposure to 1,000 British pound, okay, by netting your receipts and payables. Similarly, you can do it for the 2 months as well. If you see the question, there is 2 transactions, 2 months, purchase of machinery, dividend income. So net obligation is for $4 lakh. Okay, if you see here, the net obligation is for $4 lakh. Okay, now this $4 lakh, after 2 months, you can find what is the rate which is quoted, convert them into British pound. Okay, and you know what is the obligation. So net amount payable would be, basically if you see here, 2 months forward is 10 cents purchase, so 1.60 becomes your rate. Okay, so 4 lakh divided by 1.60 is what will come as your obligation. So that is how you normally do. This is what is a process in which you try and protect and take care of your obligations. Okay, same process, it's only that you can try it your own end. That here is a straight away question. You have an obligation of 4 lakh, okay, dollars as a net obligation, purchase, receive. So you have to pay $4 lakh towards the machine that you are purchasing in 2 months time. You can net it with the dividend income that you are going to receive in 2 months time. Both are in dollars terms, so your obligation is 4 lakh. But for the British pound, to convert them into now when you want to pay the bank purchases, so it's a buy transaction, so 10 cent, 11 cent, this is at a premium now. Okay, so the rate that is applicable, 2 months forward rate. So 2 months forward rate becomes what, 1.5000 plus 0.1000, 10 cents, so it becomes 1.6000. Okay, so simply if I want to find the net obligation to be paid in British pounds, so it would be $4 lakh divided by 1.6, so it would come to somewhere around 2,50,000 then. Okay, so please try such questions as come in your past exam, and the more you will see, the more you will practice, the more you become comfortable, okay, doing such type of problems. Now going further in this particular product of forward exchange contract, let's try and see different variations that could happen when you deal with foreign exchange transactions, forward contracts basically. Now we are talking of bank being one party to all such transactions. So there is a provision that a person might take an approach in the sense that he has entered into a transaction with a bank in foreseeing that the payment would come on a given day, but maybe it's not happening, or something went wrong in between and he wants the contract to be cancelled now. Okay, so that's where there is a cancellation of forward contract which is possible. Or else he was expecting a payment in 30 days time, and the process is getting delayed, so it's not the payment would happen later than 30 days. So he should have some provision, some mechanism wherein he could extend the contract. Okay, or else he was expecting a payment in 30 days time and the payment got realized quickly, and he doesn't want to keep the exposure on, so he wants to execute it early. Okay, so such permutation combinations could be possible when somebody is dealing with a forward contract, and that is what we are trying to discuss going further. That means we'll take one at a time. So first to discuss is cancellation of forward contract. Now, in an absence of any instruction from the customer, okay, if a customer has not given any kind of a standing instruction regarding his contract, that what should happen if it gets matured, okay, so all contracts which gets matured automatically gets cancelled on the 15th day from the date of maturity. Okay, that is one thing. Okay, that if you as a customer has not approached a bank after maturing of your forward contract, then automatically on the 15th day from the date of maturity the contract gets cancelled. Okay, now in case of the 15th day falls on Sunday or it's a holiday, then the contract will be cancelled on the next working day. So those mechanism of rolling would happen. Now in such kind of a transaction, okay, that means you as a bank with you the customer of a bank, the bank has entered into kind of an original forward contract. Now it has to cancel that forward contract. Now cancellation of that contract might happen at some other rate, because there is a lag of 15 days suppose. So any kind of an exchange loss that has happened is recovered from the customer under advice to him, and the customer is not paid any kind of a gain that could happen, because you have not instructed for the contract to get cancelled. Okay, and it has automatically got cancelled on the lapse of 15 days. So if there is any loss, you have to bear that loss as a customer. If there is any gain, the bank will not pass on to that. So forward contract can be cancelled at the request of the customer, provided that this request is coming before maturity. Okay, so if it's happening before maturity, you are approaching a bank and you are requesting the bank to cancel the contract. In that case, the bank would recover, would pay any, depending on the case, whether it's a profit or loss. So they would recover or pay the difference that could happen between the contract rates at which the contract gets cancelled or is affected, and such kind of a gain is paid to the customer, and if there is any loss, that is recovered from the customer. So only if a customer approaches a bank before maturity with a request of cancellation is when you get a benefit, or okay, in either cases your loss is to be borne by the customer. Okay, the loss has to be borne by the customer. So only if there is a request which is happening before maturity is what we're talking of cancellation of forward contract. Otherwise the standard pattern of cancellation is that any contract which is matured and there is no instruction from the customer gets automatically cancelled on the 15th day from the date of maturity. Okay, so those things kept aside. Then how do we go about dealing with cancellation of a forward contract? So the cancellation at the request of the customer can be studied in three parts. One is that if the cancellation is happening before the date of maturity. Okay, so if we see here that if the cancellation is happening before the date of maturity, that means you are approaching the bank before maturity and you are requesting the bank to cancel the contract. The bank, what has happened originally, that when you entered into a forward contract with the bank, suppose you entered into a purchase contract with the bank, now bank would have offloaded that risk entering into a sell contract with the market. Okay, so when you approach a bank to cancel your purchase contract, forward purchase contract, the bank's obligation to forward sell is still there with the market. Okay, so it has to enter into a counter trade to forego or to offload that kind of an obligation. Okay, so the bank would enter into an opposite contract with the customer. The new contract will be of the same maturity. So if the original contract was for 2 months, you come after a month saying I want to cancel the contract. So you originally was of 2 months contract. Okay, if you were with purchase with the bank would sell. Okay, so the bank would enter into a sell contract 1 month maturing to meet the obligation that it has taken from you. Okay, because what it is going to get after 2 months is going to offload it to you. It was supposed to offload it to you, or what is going to take from you is supposed to offload it to the market. Okay, where some mismatch has happened, that you came early saying I want to cancel the contract, the bank is standing under obligation to receive and to pay, So it would enter into a contract today for the remaining date of maturity to offload those obligations. Okay. Now that is what it says, the corresponding cancellation contract. Okay. And this maturity should match. So the new contract will be of the remaining maturing date of the old contract. So that is one thing, first step. Now, if the cancellation is on the due date, okay, the bank does the opposite action again in the spot market. That means if it's on the due date, it does not have to take up a forward contract. Today only it was supposed to take your money and give it to its obligation, or okay, take from his obligation and give it to you, depending upon whether it was a purchase or sell contract at your end. So it would do the opposite. That means if it's taking dollars from you, it was supposed to take dollars from you, it would be selling spot. Okay. So if, or else if it's selling to you, then it will be buying spot. So that is what we're trying to understand here, that the bank would do opposite action in the spot market. Now, if under the original contract the bank was to sell a currency to a customer, the bank would purchase the currency from the customer on the spot basis, and any recovery or payment that would happen because of the differential would be paid to you or taken from you. Okay. Now, if the cancellation is after the due date of maturity, okay, but before the 15th day after the date of maturity, okay, so we are trying to take a different variation. Earlier we said that any contract which is not executed 15 days after the date of maturity, it automatically gets cancelled. But the contract has got matured, you are approaching after maturity but before the lapse of the 15 days. In that case, the bank would again do the opposite action, as the bank is having a standing obligation with the market, and any kind of an exchange loss would be recovered from you, and any kind of gain on such transactions will not be paid, because you have approached the bank after the due date, okay, after the maturity of the contract. So only when you are approaching a bank before your maturity of the contract or on the date of the maturity of a contract, obviously if there is any loss happening because of the counter trade or because of the cancelling trade, then the loss is to be borne by you. Otherwise, the gain is passed on by the bank to you, because the rate could fluctuate. You can never be sure whether it's going to be up or down, and you cancel the contract. Why? Because you could not meet the obligation that you wanted to enter going forward. Okay, so that's what is allowed. You are allowed to cancel the contract provided you are willing to bear the losses that could happen because of the counter trade getting cancelled, because the counter obligation of the bank to be met in that case. Okay, they will enter into a opposite transaction with the market. Okay. So this was one thing. So let's try and take one illustration to understand it better. If you see here, the customer with whom the bank has entered into 2 months, okay, 2 months forward purchase contract for euros 5,000 at 54.50. Okay, so the original contract was for 2 months forward purchase. Okay, so what would have bank done? If it's entering into a purchase contract with the customer, it would have entered into a sell contract with the market. So after 2 months, you are going to purchase euro. The bank has already got a sell contract with the market, so the bank would purchase euro from you as a forward purchase contract with the bank, means the bank purchasing from you. So the bank would take euro from you and give it to the market. That is what the main transaction was. Now the customer comes to the bank after a month. So let me just try and change the color for that. So after 1 month, there is a request of cancellation of the contract. Okay, and on that day the rates were prevailing: spot 54.60, 54.70, 1 month forward 54.90, 55.04. Okay, now you have come after 1 month, so there is a 1 month lapse. 1 month is left, okay, for the original contract to get lapse. So the cancellation could happen because they are approaching it before the maturity, but then at that point in time, the bank would enter into an opposite transaction with the market, okay, with the customer. So on maturity, so what would happen in this case? The bank would enter into a forward contract of the same maturity, say 1 month forward contract, okay, of sell, because with the customer the contract was of purchase. Okay, so what would happen? So on the date when the customer approaches, so on the date of request of cancellation, okay, what would happen? bank will enter into a forward with the customer. The contract was forward purchase. Okay, so you enter into a forward sell at forward sell 1 month contract. Okay, so rate at that time would be forward sell 1 month is 55.04. So at 55.04 to a euro. Okay, and this is the contract which is basically to offload the original obligation of the bank. Okay, and on maturity what would happen? That means on maturity, again the same process. The bank would sell, the bank will sell 5,000 euros, okay, to the customer at 55.04, okay, the contract for which it has entered. So this comes to rupees how much? 5,000 into 55.04, it comes to 2,75,200. Okay, that was one transaction, and this was under the new contract, the contract that we talked about on the date of maturity. Okay, on the date of cancellation that the bank has entered into, and then subsequently it would purchase because it has entered into a forward contract. So the bank would purchase as per the agreed contract. Okay, as per the agreed contract, would purchase from the customer 5,000 euros at the rate that it has entered, 54.50. 54.50. So it comes to how many rupees? 5,000 into 54.50. So it is 2,75,500. Sorry, 2,72,500. 2,72,500 rupees. Okay. So the bank is purchasing low, selling high. So there is a loss. So the loss of rupees, is 2,700. So 2,700 is the loss that has happened in this cancellation process. So that has to be borne by the customer. If the customer pays this loss, the contract would be cancelled. So the cancellation settlement all happens on maturity. So you approach a bank before maturity, say a month before, that I want to cancel my original contract which is going to mature a month later. So the bank would enter into an opposite transaction for the remaining date of maturity, and on maturity would square up both the transactions. If there is any kind of a loss happening, it will be taken from you. If there is a gain happening, it will be paid to you. Okay. So this is how there is a process of cancelling if in case there is a request from the customer. So cancellation of forward contract on the request of customer is only possible if the request is coming before maturity, okay, or on a date of maturity, and you have then to remember those steps that could come handy. Okay, so this was one way of using forward contract, which is cancellation of forward contract. Okay, so we have discussed about forward contracts in the way that if there is a possibility of customer coming up with a request of cancellation, then how do a bank go about doing such kind of a transactions. Now in continuation to that, let's see that what if somebody wants to extend a contract. So if you are approaching a bank as a customer and you request that I have entered into a forward contract of say purchase or sale for say a month expiry or month maturity, but then I have some reason to extend it. I have some requirement to extend it for another a month or two. Okay, so and at the same agreed price, that means the price that was entered when I took up the original contract, even the extended contract should have the same price. Okay, so in that case, how do a bank commit to that? And obviously So in that case, how do a bank commit to that? And obviously, in doing such kind of a transaction, if there's any kind of a loss or gain that would come across, so if there's a loss, then the customer has to bear that loss. Okay, so those conditions remain same. So let's try and see this case, this situation. That what if there is a cancellation requirement? So if you see here, we're talking of what if there is an extension requirement? Okay, so if you see here that extension is permissible, that means the bank could do that, okay, to the on the customer's request, but then that should come, the request of extension should come before maturity of the contract. That means otherwise then there is obviously a cancellation. We have discussed that if a contract gets matured, then automatically 15 days from maturity all the contracts gets cancelled, whether you have undertaken that or not, because we are talking of a forward contract here, which is obligatory on both the parties. So if you are customer as well as a bank, okay, the contract is obligatory. So extension is permissible, the bank would do that provided the customer has requested before maturity, and in that case the bank would take two steps. Okay, there are two steps that the bank would take. One is that the bank would cancel the original contract because the original contract has not been extended. Okay, so the bank will take all the step that is required for cancellation that we have discussed earlier for any contract before the date of maturity. So the process that we discussed earlier when we discussed forward contract, cancellation of forward contract would be the first step, and then subsequently the bank will enter into a new forward contract maturing on the date of the date that is requested by the customer. Okay, so if in case you have a contract which is maturing say 15th of a month, and you need to extend that say to maturing for 25th of a month. Okay, so the 15th month maturing contract would be cancelled, and then a new contract would be taken for that particular maturity. Okay, so that's what was one. And then obviously the Foreign Exchange Dealer Association of India, FIDI guidelines would govern it, and there's they call it in this book as cancel and rebook. Okay, so the term that is used up in industry is to say cancel and rebooking of the contract. Okay, and obviously in doing this cancellation and rebooking, if there is any amount of loss or gain, so that will be received from or paid to the customer. Okay, at the time when the customer approaches the bank for extension. So when you are approaching before say maturity say 15th, at that time itself the loss and gain would be taken or given to you. Okay, and obviously on the extended date the contract would be executed. Okay, so these all things are there. That means you enter into a forward contract with the bank because you had some risk to protect, you have some exposure to take care of. Now you have entered into, as being a forward contract, we did make a point that it's customized, that you can have your desired date, you can have your desired terms, conditions which a bank would agree and accept and give you a contract. And the same contract can be cancelled, can be extended, can be early delivered also. That means if you don't have to wait till maturity, you can enter into an early delivery situation. Okay, so that is what we are trying to discuss, different forms of using a forward contract. Okay, so this is another application, another very practical situation where because of reasons you foresee that I need to extend my contract, you can approach a bank and stick to the same agreed price that the bank has accepted giving at the earlier instance when they have entered into an original contract. Okay, so that is what this is. Okay, so let's try and see one example. Okay, so if you see this example here, this example is for extension of a forward contract. So if you see in this case on 15th of July, okay, a bank is booking a forward sales contract of a customer. So there is a forward sale contract which is booked for USD 2,50,000, which was due on August 30 at 48.35 a dollar. Okay, so this was on 15th of July, maturing 30th of August. Okay, now 20 days before maturing, that means on 10th of August the customer comes requesting, okay, the customer requests the bank to extend the forward contract for a month, that is 30th September expiry now. So you originally on 15th of July took up a contract of expiry on 30th of August. So before maturity 30th of August, 10th of August you are approaching a bank saying I want to extend it for a month, say 30th of September. Okay, and on this date, that is on 10th of August, the exchange rates which are prevalent is given. So you know that there is a spot rate 481325, 481675. We know that there is a two-way quotations given. So buy low, sell high. So 481325 is buy rate given by the bank, 481675 is the sell rate given by the bank. And then there are some forward rates. These are outright rates been given. That means including margins, it's been quoted straight away. In this case, it's quoted at discount. So the forward 3 months contract, okay, is 476625, 477175, and the forward 30th September contract is 474425, 475375. Okay, so these rates are at discount, and this question simply says that at what rate the contract will be extended. Okay, and what is the amount of gain loss that would be taken or given by the customer. Okay, so we are talking of this requirement, that at what rate the customer the contract will be extended, and what amount of gain loss will be receivable from or payable to the customer. So if there is a loss, it is taken from the customer. If there is a gain, then it is paid to the customer. Okay, but obviously this contract of extension should be, the request of extension should be coming before maturity of the contract. Okay, so let's try and see the steps and how this situation would be handled by the bank. Okay, so what I'm doing is I'm taking a new whiteboard and would appreciate that we do it together. So so what would happen in this situation, there would be certain dates. So on 10th of August, there is one date, because on that date you're coming and approaching a bank saying I want to cancel your contract. So what would happen on that day, if you see, the bank will enter into a forward contract with the customer. As we said that since you are wanting to extend it by a month, so there will be the contract that the bank would enter would be, there will be two contracts. So the first one in this case would be buy 2,50,000, okay, dollars USD from the customer on 30th, because that was the original contract. Okay, on 30th of August at your agreed price of 47.6625. Okay, so if you see in this case 47.6625 is the rate which is forward of 30th of August. Okay, so that would be the one. Okay, and this contract is necessary for cancellation on 15th of July, and subsequently there would be a second contract that the bank would enter into, that it would sell $2,50,000 to the customer on 30th of September. Okay, at that rate. So 30th of September rates, if you see in this case, is sell rates at that time is 47.5375. Okay, so this rate would be that they would enter into, so 47.5375. Okay, so this is one rate. This would happen on 10th of August when the customer has come with requesting of cancellation. Okay, because you have entered into an original contract of maturing of 30th of August, and if we see in this question, the contract was a forward sell. Okay, so the bank has entered into an obligation to sell, so it needs to do a reverse transaction with the customer. So 30th, they will take up a buy position from the customer on 30th of August rate, and will take up a sell position, okay, for 30th of September. That is what was the original contract, which is now extended. So sell contract of 30th of August is now extended as sell contract of 30th of September. Okay, so this second contract is what is been the extension contract basically. Okay, so this was one date. Now on 30th of August, okay, again if we see in this case, the bank would sell. So there would be again two type of transactions as a cover transactions basically. So the bank will sell $2,50,000 okay to customer because under the original contract. Okay. Under the original contract, okay, at whatever rate that was agreed. Okay. So the original contract was for 15th of July in this question. If you see, the 15th July was the contract that you originally entered into, and the rate was 48.35. Okay. So 15th July rate of 48.35. Okay. So what would happen in this case? It would be 2,50,000 into 48.35. So taking the help of calculator, if you find this 2,50,000 into 48.35, okay, it comes to INR how much? 120,87,500. Okay. And the second transaction that would happen on 30th of September or 30th of August would be that the bank would purchase, it would buy $250,000 from the customer. Okay. That is this transaction that earlier that was happened. Okay. The transaction would be executed at the given rate. So at that time the rate that is accepted is 47.6625. Okay. So so this would come out to be 2,50,000 into 47.6625. So when we multiply this 2,50,000 into 47.6625, it comes to INR 119 lakhs 15,625. Okay. Now if we observe here, okay, there is a loss. You're buying at 119 lakhs 15,625 and selling at 120 lakhs 87,500. So there is a loss, okay, of rupees. If you check the difference, it is 120 lakhs 87,500 minus 119 lakhs 15,625. It comes to 1,71,875. Okay. Now this loss will be recovered, okay, from the customer on 10th itself. On 10th of August, when the customer has come to extend the contract, because you are agreeing into a forward rate on the prevailing 10th rate. On 10th, what is the rate of the original date, 30th of August, when the contract would not have been extended, would have been executed. So what is the rate now at that time when you're requesting for extension? So I'll know the position, whether it's a gain loss happening at that point in time. Okay. So these were the two things, and then subsequently on 30th of September, okay, when the extended contract, okay, the bank would sell, okay, because the obligation was for a forward sell contract. Okay. So it will sell to the customer at the rate now that it has extended. Okay. So what would happen in this case now would be that the bank, there would be only one transaction now, the execution of the obligation that the bank has taken with the customer. So the bank would will sell $2,50,000, okay, to the customer okay, at the agreed price. Now the price that we are talking of here is the September's price, okay, at 47.5375. So eventually, effectively, if you see, because the customer has paid the loss of extension, because the rate has fallen because of being at discount, for customer it's eventually the same contract. For him is under the obligation of selling dollars at the pre-agreed price of 48.35. Okay, so this is how it goes about. This is how a particular contract or particular situation in forex market is handled by a bank. As we said, that mandatorily the second party in such transactions would be banks. So the transaction that we are talking of is with the bank and its customer. Okay, so this was what we are talking of when we are talking of extension of forward contract. Let's try and see another application of forward contract where there is an early delivery of forward contract. So we talked about cancellation, we talked about extension. What if a customer comes up with a request of delivering it early? That means you originally was under a contract of say executing on 30th of a month, but then you come 15 days before to say I want to execute it now. Okay, now in all such situations that we have been discussing, the counterparty bank here has the only concern that to hedge its risk, to manage its exposure, the bank would have entered into a reverse contract with the market. So if with the customer, the bank is taking an obligation of buying say on a 30th of a month, and then subsequently to offload that obligation, offload that particular exposure, the bank would have entered into sell transaction with the market. Okay, now the customer is not coming on 30th, is coming on 15th to say I want to deliver it now. Okay, and the rate that is applicable would be the same in that case, which the bank has agreed earlier in the original contract, but then the bank is still under obligation with the market. So what, okay, so the bank, that obligation has to be met by the bank. So the bank would enter into a set of transactions to meet its obligation, as well as to give the rate that it has quoted to the customer in the original contract, even if it's coming with a request of early extension, early delivery. But then obviously, if there is any loss or gain that is happening, would be has to be borne by the customer. So if there is loss happening, the customer has to bear that loss. Okay, so that is what is the base of all such provisions given in forward contract. Okay, because of being an obligatory contract on both the parties, okay, bank as well as the customer, that is what was the nature of the forward contract. So it's a contract which is obligatory on both the parties. Okay, so the obligation would still be met, but then end of the day, if there is any kind of a loss happening, the customer has to bear that. If there is a profit happening, and if the request is coming before maturity and the bank is working out on the set of transactions to see how it can execute its obligation, then obviously if there is a gain happening, that will also be passed to the customer. Okay, so that is what is the application part that we are discussing in this set of transactions. So let's try and see this application of early delivery of forward contract. Okay, so if you see here, there are three parts, or different parts is what we can study this process. Okay, so the early delivery can be divided into three parts. Okay, so the first part is that take delivery on spot basis and make provisional payment on the original contract, okay, that you have entered. So when the customer is coming 15 days before to deliver the contract early, so you will take the delivery on spot, okay, and then obviously make a provisional contract payment for your obligation towards your original forward contract. Okay, so the net effect of these two steps, if you see in this case, the net effect of these two steps is that there will be either a debit or credit balance in the customer's account. Okay, but then this would be settled at the time of maturity. Okay, so at the time of the maturity of the original contract. So when you enter into a 30th expiry contract of any given month, then on that date this would be settled. Okay, so that is what we call as final settlement, along with the interest. Okay, so if there is any kind of a profit happening for the customer, that amount is with the bank for the remaining 15 days. The bank would be also willing to pay interest on that. Okay, and that normally is done on the prime lending rates. Okay, so the customer interest rates is applicable on their prime lending rates, PLRs. Okay, now if there is a credit balance, in this case the customer's account of the bank would pay interest. Okay, so if it's a debit balance, will pay interest at the rate of fixed deposit rates. Okay, so in case of credit balance, it will be fixed deposit rate. Otherwise, in debit balance, it will be prime lending rates. Okay, so debit balance would have prime lending rates. Okay, if it's a credit balance, in the customer's account because of the set of two transactions, then it would be at fixed deposit interest rates. Okay, so this is a first part, that you will take the delivery on spot because it's coming early to you, and you will make up a provisional payment on the original contract of original maturity rates basis. Okay, so this is one step, one part of the study. The second part is that you will enter into a fresh contract because you have an obligation with the market. As we said that the bank, under banking system, as a bank, you are not supposed to take exposure because it's a business where you literally have to work out on managing your liquidity against profitability. So you can never be in a situation of taking overexposed risk. Okay, so the bank would have entered into its reverse covered contract with the market when it enters a contract with the customer. So even if the customer is coming with the request of early delivery, the bank is having some obligation. So what would happen in the second part is that a fresh contract of cancellation for the original contract would be entered. Since you are originally taking a contract of 30th expiry, okay, so that has to be cancelled in this case. So the bank would enter into an opposite forward contract with the customer. The entire process of cancellation would be repeated. So under the original contract, the bank was to purchase, suppose, from the customer. The bank would then sell that currency of forward on forward basis to the customer, and the new contract would have the same maturity, okay, of that of the old contract. So if with the customer you had a purchase contract, you will now enter into, okay, the entire process of cancellation that we have discussed. Okay, so that is the second part here. And then subsequently on maturity, the third part. So on maturity, the bank will execute both the forward contracts, okay, original contract as well as the contract that is entered on early delivery. And under the original contract, the bank will purchase the foreign currency if it has entered into a purchase forward contract, and under the new contract, the bank would sell the foreign currency, and the customer's account would then be settled with interest, okay, interest in the form of whether it's a debit or credit balance in the account. Okay, so that is what was the process. That is what is how process of delivery would happen if okay, like that could only be three. Either you execute the contract on maturity on the pre-decided date. If not, then you would have options of extending it, cancelling it, okay, or giving it early. Okay, so these are the three permutations. These are the three possible ways in which a forward contract could be handled by a bank. Okay, at the agreed price. So that means for a customer, the rate that the bank has quoted would still remain same. Okay, so this is the third application of forward contract. Okay, the two that we have discussed was cancellation and extension. Third is early delivery. Okay, so let's try and see one application, one example on this. And as we have been doing, I'll take up a whiteboard and would appreciate that we do it together. Okay, so if you see in this particular example, which is of early delivery, that you are working for a bank, and on 1st of May, you enter into a forward contract, okay, with customer for purchase of USD 1 lakh, delivery of 31st July, okay, at the rate of 48. So at 48, delivery 31st of July, you entered into a contract with your customer of purchasing 1 lakh USD, and that was on 1st of May. Okay, now what has happened on 1st June, okay, which is like 2 months before. So 31st of July is when the expiry of the contract is happening. On 1st of June, the customer has approached the bank with a delivery of 1 lakh USD, okay, against the original contract. Okay, so it was supposed to be delivered on 31st of July, and you came almost 60 days before on 1st of June to deliver it. Okay, and on that given date, on 1st of June, the rates that were prevailing in the market, spot rates were 49.2825, and it's a locked in rate. Now locked in rates are basically where the bid and ask rates are same. Okay, so in that case, you get only one quotation. The bank would be willing to buy as well as sell at the same rate. That is what we call is a locked in rate. And you get a forward July 31st, which was the original date of maturity of the contract. You get a forward rate which is again given outright in this problem as 48.8025 for buy, and 49.8025 for buy, and 49.8875 for sell. Okay, so here it's at premium. Okay, so margin is at premium. That premium has been added to the spot rate, and that is when we say you're quoting it outright. Okay, Now in this case, in this problem, there are further informations given that the bank's prime lending rate is 13%. Okay, it accepts deposit. So the deposit rate for 2 months is 4.5% per annum. So you have been asked that what amount of loss and gain will be received or paid to the customer. Okay, so the same situation. That means you're coming on a given day, on say in this example 1st of May, to enter into a delivery of bank entering into a purchase contract. So the customer giving 1 lakh USD on 31st of July, for which the bank has entered a rate of $48, but then you come almost 60 days before to deliver it. Okay, and in that case, how would a bank go about, okay, executing such transactions? So that is what we're talking of here. So what would happen again, different dates. So on 1st of June, when the customer is coming with a request of early delivery. Okay, so there will be 3 steps that the bank would take. Okay, so the first would be that the bank would purchase say $1 lakh, okay, from the customer at spot rate. Okay, because it's coming on that day to give. So the spot rate applicable on 1st of June, okay, is 49.2825. So spot rate, that is 49.2825, which is even the locked in rate. So the buy and sell rate in this case is same. Okay, and what would it do again is that, as we have discussed it, that it will pay the customer the rate that it has agreed. Okay, so the bank would pay the customer at the original rate. Original rate of 48.00, that is what it has entered into. So 48.00 was the original rate that was entered at the time of execution of the contract. Okay, so what is happening in this case, if we see these 2 steps, here you have 49.2825 into 1 lakh, okay, 49.2825. So 49 lakhs is what you're getting in this case. Here it is 48 lakhs. Okay, so the net effect that we are seeing in this case is that there would be a credit balance, okay, of how much? 1,28,250. Okay, there will be a credit balance of 1,28,250. Okay, in the customer's account. Okay, so at the time of final settlement, okay, on final settlement, the bank would pay interest, okay, at, since being a credit balance, at their deposit rates. Okay, at deposit rate of 4.5%, that is what is there in this question. The deposit rate for 2 months is 4.50 per annum. Okay, per annum, okay, for 2 months. But that would be paid on maturity, that is on your for the duration, that is 2 months. When we say in this case, we are talking from 1st of June till 31st of July. So for this duration, the interest would be paid. Okay, and subsequently, as a second part that we have discussed in the study, the third step that the bank would do would be to protect its exposure. So the bank will then enter into a new contract with customer, to sell dollar 1 lakh, okay, to customer on forward, okay, basis maturing 31st of July, okay, at the prevailing rate which is there at that time. So that time the sell rate is 49.8825, okay, so at 49.8825. Okay. Now this contract is necessary for cancellation of first original contract of 1st of May, okay, because that contract would be there in the sense that the customer has come early to deliver, but then there is an exposure still there, contract exposure still there that the bank would be having, okay. So this is how it would be, okay. So on 31st of July, okay, that is the date of maturity, okay. So the bank would sell at this given rate of 49. So that again would be 2 transactions. Sell 1 lakh dollar at 49.8825. So this is what was the transaction that we're talking of here, okay, and buy 1 lakh at the customer's agreed rate, okay. So buy 1 lakh at 48.0000, and on this 2 transactions, okay, 1,28,250 is what is you're getting, you're selling high, buying low, on which you would be then paying an interest at 4.5% per annum for 2 months, okay, and that is what this interest amount when calculated would be what we say is your final settlement. So all these things happens, all these things is how you can work it out, you can see what exactly would be the amount that would be settled in this case, but this is how the execution of forward contracts would happen in any given okay, situations, okay. So this is all applications of forward contract that we are talking of. Either you can cancel it, you can extend it, you can give it early, but then in all case if there is any kind of a loss happening, the customer has to bear that. If there is any gain happening, you are doing it before maturity, the request is coming before the maturity, the bank would even pass the gains to you, okay. So that is how you need to see. There has been questions that has come from such applications in past, and all these questions that we are illustrating has come in past exams, okay. So important topic, you normally get 2 questions from this particular chapter, but then this topic becomes one of the most important one in sense of practical question, apart from hedging applications of for foreign exchange contracts, okay. So you get 1 complete question for sure. So again, that in that sense this chapter, this topic becomes important, okay. So this is application of forward contract. The other application type of question which has come in past exams predominantly in the form of short notes has been to discuss rollover contracts. As frequently this is a concept which normally has been asked, so we can stick with understanding it in that sense, but then obviously there could be a practical illustration that we can also build into how it's been done, but then of late it's only been asked as a short note, okay. So let's try and understand what it is. So rupee rollover forward contract, so it would be like, if you see here, that there could be situations in foreign currency market wherein there could be foreign currency loan which needs to be repaid in installments, but over a number of years, okay, or you are importing on a deferred payment basis, okay, and the amount that you are paying is also different on different dates. It's not as a fixed date, okay, and use duration of repayment, and in all this holding on period, the exchange risk is involved, okay, since you are paying in foreign currency terms. So forward contracts for dates which is falling after 6 months, is practically not available, because nobody could probably foresee the interest rate scenario. Okay, although a bank could quote you even more than 6 months rates, but then generally it's not that frequently been practiced. So in such situation, there is a rollover forward contract which is used, okay, to cover your exchange rate exposure. So in rollover forward contract, it is where a forward contract is initially booked for the total sum of loans. So if you have taken a loan, heavy loan of say $1 million USD, and you're repaying it, okay. So as and when the installment falls due, okay, at that particular time, the foreign currency and the exchange rate needs to be fixed in your forward contract, okay. So the and the balance amount of the contract would be rolled over, extended. So it's a type of extension of a contract, okay, till the time the next due date of the next installment is falling, and the process of extension continues till the time the entire loan is being repaid, okay. So this is when we say a rolling over. You're taking an original say $1 million worth of dollars contract, but then entering into a forward contract of your first installment due date, and then accordingly rolling over, subsequently rolling over, and likewise, okay. So this is what the concept is. There could also be cross currency forward contracts, as we have discussed, that you get cross currency rates. So the forward contract in which two foreign currencies are involved is known as a cross currency forward contract, and when these types of contracts are rolled over, they are called as cross currency rollover forward contracts, okay. So in past you have been asked to give a short note or explain this concept of rolling over or cross currency rolling over of contracts, okay. So that's why refer the faculty note to even understand it better, but then it has come off late only as a concept question, as a short note question, okay. But then for your practice, you can have this example that you can look up to, where the contracts have been entered into and forwarded. So refer the practice set of questions and see how you can do that. But then, as I said, predominantly the question that has come from forward contract has been either a situation of extension or cancellation or early delivery, okay, or exposure netting or such kind of a situations, and rollover contracts have probably been a kind of a concept question which has come in past, okay. So this is where we'll like to conclude the first instrument of forex product as forward contracts, okay, and then we'll continue with another product as futures, and subsequently options and currency swaps and other things, okay. So this is where we'll try to conclude the forward contract, okay. So a currency futures contract is a contract to buy or to sell, okay. As we said, the difference is only that it's over the exchange traded contract. So it's exchange traded contract as compared to over the counter. So when it's in the standard format, standard quantity of foreign currency, okay, at any given future date, okay, price that is agreed upon. So all terms conditions between forward futures remain same that we have been discussing. We have also elaborated at length when we talked about it in chapter of derivative. So that all holds true. So these are standardized contracts which are traded on organized futures exchanges, and in most cases these contracts would be settled in cash, as we talked about when we talked about futures at length, okay. The 5 features of these contracts would be that they're exchange traded, they're standardized form, okay, standardized size, lot size and all. The maturity date would be specified, there would be mark to market happening, the profit loss in their account would be taken, given, and these are contracts with an exchange. So there is no counterparty risk involved, okay. So those features would always be there. So discuss it see it at length with your faculty notes. The difference between forward and futures contract, as normally it's been asked as a concept question, is on various parameters. So broadly, if I want to list few, again to reinstate what we have been what we also discussed when we talked about okay, the forward contract. So we said of in the form of regulation, okay. The forward market is a self-regulatory mechanism, whereas the future markets are regulated by exchanges on the basis of size of the contract, okay. Forward contracts are individually tailored, customized. They tend to have much larger than the standardized contract size value, and futures contract are standardized in terms of currency amount, okay. And then it could be the delivery date, The bank offers forward contracts for delivery for any date, wherein the future contracts would be available for delivery on a specified dates only. On the basis of settlement, it can be different. Okay, the forward contract could be settled, settlement of it could occur on the date which is agreed upon between the bank and the customer, wherein in case of futures contract, the settlement is made daily via mark to market by clearing house. The gain on the position value would be given, and the losses would be withdrawn on a daily basis, which we have understood at length when we talked about marking to market. Okay, and on the basis of quotes also. Okay, so normally if you see the forward prices are quoted in a direct way. Okay, so there is direct quotation where you keep the foreign currency constant and fluctuate the home currency, wherein the future contracts are generally quoted in indirect way. Okay, indirect form, wherein you keep the foreign currency constant. Normally we use 1 rupee. Okay, we quote it as 1 rupee equal to these many dollars or something like that. So that is how on broader terms we can classify and differentiate, okay, the forward and futures contract. Okay, all other things would remain same, what we have discussed at length when we talked about futures fundamentals and in our derivative chapter. Okay, so let's try and see one situation, okay, one application of whatever we have been trying to discuss as an application of futures contract. So if you see here, XYZ Limited is an export-oriented business house based in Mumbai. The company the company invoices in the customer's currency. So being an export house, it invoices in a customer currency. Its receipt of USD 1 lakh is due on September 2005. Okay, so some any date. This is again a question which has come in past exam. So a lakh USD is due to receive by this firm on September 1st, 2005, and we are on 1st of June 2005, suppose say. Okay, and we have some informations given that the exchange rate spot is $1 to INR is 0.2140, 1 month forward, okay, 0.2136, 3 months forward 0.2127, and in futures currency market the contract size is for $4,72,000. Okay, the contract size is for $4,72,000 in case of futures. And then we have certain requirements that the futures are quoted. June futures spot is 2126 and September futures is quoted at 2118. Okay, and there's some initial margin requirement which happens in futures contract. We talked about that in the form of mark to market. So for September contract, the margin requirement is $15,000 and the rate that is applicable is 8% per annum interest. Okay, now there is further more information is given that on 1st of September the spot rate is 2133 and the futures rate is 2134. Okay, so you have been asked to recommend what you should do, whether you should use futures, okay, or use forward or do no hedge. Okay, so that is what is the situation. It's not exactly that we are talking of futures, but then since there are different markets, you can go to a bank and enter into a forward contract, you can go to an exchange and take up a futures contract. So what you should be doing is what we are talking in this case. Okay, so let's try and see how do we approach. And there is an assumption made in this problem that the variation in margin would be settled on maturity of futures contracts. So that is what we'll keep in mind. So let's try and see that if you go for futures, okay, if you go for futures, then here if you see the futures, so if you're going for futures, if you see in this case that the rate for September futures contract is 0.2118. Okay, so what would happen in this case? You will purchase, as we have been saying, that as a hedging process. Okay, whatever you're going to do in future, you do it today in derivatives market. So you are anyway going to purchase dollars because of the invoice that you will be receiving USD. Okay, 1 lakh is due on September. So as an export customer, you would be selling it to the bank would be purchasing. So we're talking from bank's point of view, as we have been saying it, all transactions are with reference of bank's point of view. So in this case, in futures case, you purchase September futures contract. Let me change the color. So you purchase September futures contract at rupee 1 equal to $0.02188. This is what is given here. Okay, and so what would happen in this case? You need a lakh of USD at 0.2188 rupees. So how many rupees would this come? Okay, INR would be, if I take help of calculator, 1 lakh divided by 0.02188. So it comes to 47,21,435. Okay. So since one contract is for 4,72,000, so number of contracts in this case would be, since you need to take up 47, so roughly it would be 10 lots. Okay, so here you will say number of contracts, okay, will be INR 47,21,435 divided by lot size of 4,72,000. Okay, so it comes to 10.0030, okay, contracts. So we can say 10 contracts. So 10 contracts is what you'll enter into. Okay, so on close, since we have discussed that if you open a contract, then you need to as a purchase, you need to close the contract as sell. Okay, so on close, that is on 1st of September, when you are closing the contract, when the actual receipt is happening, you are closing at that time the spot would remain same. So we have been given that rupee 1 on September is in currency, that time it is 2134. Okay, currency futures on 1st of September is 2134. So this would be 0.2134. So your receipts from futures contract, okay, so your receipt from futures contract will be how much? Since you are taking only 10 lots, so it would be 47,20,000 into, since you're quoting it in dollars. Okay, so you are closing it at 2134 and you entered at 2188. 0. This is 02188. This is 0.0. Okay, this is 02188. So let's try and correct that. So it's 0.02188. This rate is 0.02188. Okay, so it comes effectively to $755.2. Okay, so what you have now, if you want to probably put it separately, okay, just to work out and show it separately, that the sales proceed will be you get $1 lakh as receipt, plus you get from futures $755.2. so effectively you are getting dollar 1 lakh 755.20, and you would then be, since it's happening on 1st of September, so your sales proceed would be these many dollars at spot rate of for September. So which is if you see here, the spot rate in that case is 2133. Okay, 2133 the spot rate, that is at which you will be getting. So 0.02133, sorry. Okay, so when we multiply this, it comes to INR 47,23,638. Okay, now since you're taking 10 lots, and we said that the margin requirement was 15,000 for a lot, so you will be giving a margin of 1,50,000. so in this you would be subtracting interest payment on margin of INR, how much, 15,000 is given per lot into 10 lots, so 1,50,000 at 8% per annum. Okay, as given in the question. So you see here, at 8% per annum, margin of 15 for one lot, but you are taking 10 lots. Okay, and this is for 3 months, since from June we are talking of till September. Okay, so this comes out to be INR 3,000. This is a negative value. So your net receipts, so your net receipt under futures, okay, will be the net amount that comes out, which is INR 47,20,638. Okay, so this is what we got. Okay, one part. And if you check it out, so what I'm saying is that if you do it for under forward, okay, if you do it under forward, the receipt under forward would be the receipt under forward would be, you are entering into a requirement of 1 lakh USD at a forward rate. If you see in the problem, the forward rate which is given is 3 months forward rate is 2127. 2127 is 3 months forward rate. Okay, so at this rate you will be entering into a forward contract, so it is 0.02127, and if we solve this, it comes to rupees, since the rate is obligatory in this case. Okay, so it comes to 47 lakh 1,457. Okay, similarly, if I check it out in the case of no hedge, which is given in the problems to find in different situation. So if I do it for no hedging, in that case you get the receipt on 1st of September at the prevailing spot rate of 1st of September is what you will get your realization. So in that case, when you are doing no hedging, the receipt under no hedge will be at the spot rate. So you are getting 1 lakh USD. The spot rate on that time is, if you see the problem, the spot rate on that time is 0.02133. Okay, 0.02133, and if you find it, convert it into IRR, dividing it with this, it comes to 46 lakhs 88,233. Okay, so now if we compare, okay, if we compare that in futures the net receipt is, okay, 47,20,000. Okay, when I compare it in case of forward, it is 47,01,000, and in case of no hedge it is 46,488. Then we obviously know that the receipt in case of futures is highest. So this is what is you should be recommending. Okay, this is what you should be recommending. So hedging is recommended. Sorry, futures in the given situation of the problem is recommended. Okay, so that is what you need to take care of when we are talking of such problems wherein you can use forward, futures, different rates. Okay, because as an export customer you want to see how much more of rupee comes to your account. So in the given illustration we could find that if you're going through futures, you get the best. So using futures is recommended. Okay, so such type of problem has come in past. So the more you will practice, the more comfortable you will be with these given topics. Okay, so forward and futures, as they provide protection against adverse movement in an exchange rate. Now in this case there is a common disadvantage. Okay, when you're talking about forward futures, the only difference is that they are either customized, standardized, whether they are traded on exchange or over the counter. So all of the otherwise they are a product which is obligatory on both the parties. Okay, as a buyer and as a seller, it's obligatory on both the parties. So the common disadvantage is that the buyer cannot benefit from favorable movements, okay, in the exchange rates, since it is he is obliged to sell or buy currencies at a predetermined rate. Okay, now this is apparently one of the consideration that led to some commercial banks to offer currency option contracts, and it has been offered to customers since 1983 onwards. So the currency option contract is a financial instrument that gives the buyer of an option the right but not the obligation to sell or to buy a fixed amount of currency, okay, at a fixed price on a fixed date or up to future maturity dates. Okay, now the seller of the option contract is under obligation, so he must fulfill the contract if the buyer is desiring. So the general framework remains same. Okay, so what we talked about in our introduction to derivative, in understanding the types of derivative, that options are derivative contract, okay, which is without obligation to the buyer of the contract. Okay, and as we discussed earlier, that these all type of products that we are talking of is generally settled on cash, okay, on cash basis. Options are also settled on cash. So the broader feature remains same. Okay, the reason why option could emerge is also what you could relate to from the chapter on derivatives. And the only thing that we're talking of is that if you are an export customer, you were apprehending you are expecting some payment to happen in 3 months time, and you want to protect your risk, so you took up a forward or futures contract. Now if it goes otherwise, there is no benefit. So predominantly while hedging you don't get benefit because of adverse movement. So that's where you could probably consider options in that case, that if something goes wrong, my maximum loss could happen of the premium amount, but if the observation goes right, I would end up making better profits. Okay, so just recollect what we discussed in options, and things remain same. The only difference is the underlying being currency in this case. Okay, so let's try and take one illustration. Okay, again the illustration is predominantly from the point of application of such products, not to probably go about understanding what we already have discussed when we talked of derivative. Okay, so let's try and see this example, that there is a London based firm which is supplying a nuclear machine to a New York based firm, okay, for $120 million. So the cost of the machine is $120 million. The payment is due in 4 months time. Okay, the spot rate is £1 sterling is equal to $1.58. Okay, now the London firm is apprehending that the London firm has apprehensions that US dollar may decline against British pound. Okay, Now since it's US dollar would decline against British pound, is considering a proposal of buying a put option, okay, for 4 months maturity. So the London firm is considering proposal of buying a put option, 4 months maturity, strike price $1.6. The option premium is $0.002 per pound. So you need to explain the position of the London firm on maturity. Okay, what would happen on maturity? Okay, so basic feature what we're talking of, just to reproduce here itself, that if it's a long futures, okay, when we're talking of long put in this case, okay, we're talking of purchase of a put. Okay, the London firm is considering buying a put option. Okay, so when we say a long put, we have already said that this is a strike is 1.60, say a dollar. You are buying a right without obligation to sell. Okay, so if something goes wrong, you protect your upside, your downside risk. Okay, but if your observation goes right, which you are apprehending that the USD may decline against British pound, so you end up making profits. Okay, so long put profile that we have been referring time and again. Okay, so what would happen in this case, as the put buyer gets a right of selling without obligation on maturity. So if he sells on maturity, it will be at £1 to $1.60. Okay, this is what the strike price is. That is what he's entering into. Okay, so so let's try and see the conversions. I'm just trying to utilize the same space here. Okay, so what happens? The strike price, the price at which the London firm can sell dollars on maturity. Okay, strike price is $1 equal to 1 upon 1.60, converting into pound sterling. Okay, it comes to pounds 0.625. Okay, so on exercise of the option, okay, its buyer, the firm, will get how much? 120 million. This is what is the 120 million dollars converted into pounds rate of 0.625. So it comes to British pound 75 million. Okay, now the option premium, just to continue with the given informations, the option premium that needs to be paid will be, the rate that we are saying is, the option premium is $0.002 per pound sterling. So 75 pound sterling, 75 million pound sterling into 0.0002. Okay, so this comes to dollar how much? 15,000. Okay, and this 15,000 is on current spot rate. Current spot rate is 1 pound is equal to 1.58. Okay, so the total premium could now be converted in the sense that you have $15,000 divided by 1.58. Okay, so it comes to pound sterling 9493.67. okay, which we can say is equivalent to 9494. Okay, so the net realization, if I want to write it, the net realization in this case would be, you're getting 75 million pound sterlings. So 75 million, okay, one more zero, so it comes out to 750 lakhs, on which you will be subtracting, okay, the premium that you are paying 9494 pounds. Okay, so it comes to a pound sterling 749 lakhs 90,506. Okay, now if I want to explain the position of this firm on maturity, we know that there could be only some outcomes, that either on maturity the prices could have gone up, okay, from the strike. Okay, so suppose on maturity the price is 0.625, okay, 625, then you know that the net realization would be this. Okay, that is what we have said on exercise of the option, which is at $1 at the current price of strike rate of 1.6 pound would be equal to 0.625 pound sterling. Okay, so that way we know that in this case he has the right without obligation, okay, to forego the right, because then he would not exercise his option. He will let the he'll probably go on the market rate and lose the premium amount. Okay, but if it's same, let me just try and put it as a separate color. So if it is same, then again there is no change. But then if it falls down, okay, if it falls down, what is the one that is apprehending, then he would be exercising at 1.60 only. He will be realizing the same amount, which otherwise in the market he could have got more. Okay, if it goes up, he will forego this right, exercise at the market rate, and make added profit. Suppose for instance, if it goes up and becomes say the rate from here goes up and becomes 0.68 or something, then he would forego the put option and exercise at 0.68 and make higher realization than 749 lakhs or something as pound sterling. So that is what would happen. Okay, that is how you will take up a position, that is how you will go about, okay, dealing with options, because options are derivative contract without obligation to the buyer of the contract. Okay, so he is not under obligation, and the only time when he would not exercise his put option, long put option, is when the outcome goes wrong. Okay, he is fearing the dollar to decline against British pound. If it doesn't happen so, then he would be exercising on market rate and making higher realization. Okay, so that is how you need to explain it. That this again is a question which has come in past exams. So whatever we are discussing is something which has been often on coming. Okay, so this is another product that we discussed when we talk of foreign currency. Okay, foreign exchange products. Okay, the another most important product in foreign currency market is your currency swap. Okay, as this is a topic on which you normally of late has got many concept questions to answer as a short note. Okay, so we have discussed that when we introduced types of derivatives in chapter 4. So in a currency swap, there are two parties who agree to pay each other debt obligation denominated in different currencies. So it would involve an exchange of principal amount today, an exchange of interest payment during the loan or tenure of the loan or currency of the loan, and a re-exchange of principal amount at the time of maturity. Okay, so it's basically taking obligation and in mutual benefit. So if there's two firms, okay, a firm which has taken loan, a foreign firm, say a Japanese firm taking a loan in US dollar, okay, from a US bank and paying interest in dollars, okay, and as compared to a US firm taking a loan in yen and paying interest in yen. So they can swap this obligation with each other and could benefit mutually for both of them. So please refer that relevant chapter on derivative topics on that, and recollect what we discussed when we introduced swap. Okay, but then very important product of late which has been coming. Okay, so let's try and see one illustration. Okay, how do we see an illustration as a form of application of this product? Okay, so in real life practical situation, in a given situation, how does a corporate how does an organization take such product for their use? Okay, so in that perspective, let's try and see one illustration. So if you see here in this example, there is a firm Galplus. It has been invited to purchase and operate a new telecommunications center in Republic of Perdia. The purchase price is 200 million rupees. So if you see in this case, the purchase price is 2,000 million rupees. Okay. Now the entire the center would be sold back to the Perdian government for an agreed price of 4,000 million rupees after 3 years. Okay. Now Galplus would supply 3 years technical expertise and training for local staff for these years, and for which they are going to charge an annual fee of 40 million rupees. Okay. Now Galplus bankers, they are suggesting that the firm should use a currency swap. Okay, currency swap for purchase price of the factory. Okay, with the swap of principal immediately in 3 years time. Okay, now both swaps are on today's spot rate. Okay, so the bank would charge 0.25% per year in sterling for arranging such swap. Okay, so there are some rates been given. The spot rate is 0.85. So 85.4 rupees sterling. 1 year forward is 93.94 rupees sterling, and 2 year is 103.334 rupees sterling, and 3 years is 113.670 rupees sterling. Okay. Now assuming that the swap takes place, you need to describe, provide a rational analysis as to whether the firm should accept the invitation or not. Okay. Wherein the relevant risks are been adjusted, discounted at the rate of 15% per annum, and for simplicity the taxes have been ignored. Okay, so this is what is been used. Okay, the pointers that we can take up. So it's basically again a kind of a capital investment decision. Okay, so the decision would be made end of the day, whether to accept the invitation or not would be on the basis of capital budgeting tools only. So we can probably take up the most common tool as NPV analysis to make this judgment, but then we need to take into consideration that what is the obligation, what is the cash flows. Okay, so that way we can develop the working notes accordingly. So what I would suggest is that we do together. I'm evoking a new whiteboard, and we can do together. Okay, so what is happening in this case is that your purchase price for this center is 2000 million rupees, which is equal to 2000 million divided by, okay, the prevailing spot rate at that time 85.4, okay, rupees, 85.40. so it comes to a British pound sterling of 23.4192 million. Okay, now on this there is a bank charge. For providing such swap, the bank charges is given in the problem as the bank would charge 0.25% per year in sterling. So since we have converted that in sterling, so we can simply find 0.25% of this value. So 23.4192 million into 0.025, 2.5%. So it comes to British pound 0.0585 million per annum. Okay, so if we can work out the capital budgeting decision now. Okay, so let me just try and change the color. So what we're talking of is that there are certain periods, some particulars, okay, some transactions, some particular items basically. So let's try and put it in tabular form. Okay, so we say particulars for a period or, okay, duration, and then the cash flows out of that period, the present value interest factor at your risk adjusted discount rate of 15%. So we'll top it from the factor table at 15% per annum. Okay, and then the present value of cash flow. Okay, so this is how we would go about addressing this. Okay, so let's try and take it. Let's try and take the first particular, say bank charges. So bank charges is from 1 to 3 years, is per year. So 1 to 3 years, it's a fixed sum, okay, an outflow of 0.0585 million. The figures are in million. Okay, so let's try and keep it like that. The present value factor at 15%, in this case is 1 to 3 years, so we can take an annuity factor. Okay, so let me just try and put it as a slash here. So present value interest factor of an annuity. Okay, so in this case the annuity factor would be 2.283. so multiplying the cash flows with annuity factors, you get a present value of an outflow of bank charges as 0.1336 million. Okay, and let me just try and put it the figures in million pounds sterling. So these are the inputs that we are taking. Okay, so first particular is that. Then there's an annual fee. Annual fees are different in different years. Okay, as we could see in this given question, because of the forward rates being different, the annual fees would be changing. Otherwise the annual fee is 40 million rupees, okay, per year for training and all that the firm is able to get as an inflow. So we have annual fees for 1, 2 and 3 years. If you could work out the cash flow, so you are getting a positive cash flow of 40 million. Okay, but then 1 year's forward rate is 93.94. so converting that into pound sterling divided by 93.94, so this cash flow comes to 0.425. okay, 4258, and the present value factor at 15% for year 1 is 0.870. okay, so the cash flows then comes for the first year, present value cash flow is 0.3704. okay, second year again you are making annual inflow in the form of training as 40 million, but then the rate has gone different, is 103.334. so dividing it with 103.334, it comes to 0.3871 million multiplied with the present value factor of 15% for 2 years, 0.756. The cash flow is, present value of the cash flow is 0.2926. okay, and third year again you are getting a cash flow of 40 million, but in the third year factor, third year exchange rate forecast is 113.67. so when divided by 113.67, it comes to 0.3519, and multiplying with the present value of 0.658, it comes out to 0.2316 is the present value of the cash flow. So these were some particulars. Now apart from that, okay, we have a particular as contract receipts in the form of swap. Okay, which is your swap. Okay, so what is this? This is happening in third year. Okay, this is happening in third year. So the factor of that would be 0.658, but then what you are getting is this amount. Okay, 21.4192. okay, because you're recovering your money. You're recovering your money on spot basis, because that is what is mentioned in this case, that swaps are taking place as discussed, and all this amount is happening on the spot rate. Okay, both the swaps are today's spot rates. Okay, so this 2,000 million rupees is what you're going to realize, plus additional you're going to realize another 2,000. Okay, so these are the two receipts that we are talking of here. So there is a contractual receipt in the form of swap, and then there is another contractual receipt as excess of it given by the government. Okay, so contract receipt, okay, which is in the form of other assurance by the government, which is also happening in the third year, 0.658. okay, but then obviously the third year discount rate is separate. So in this case we can directly take the cash flows as we have worked it out earlier. Okay, in contract it's in the form of swap, so it's a positive cash flow of 23.4192 million. Okay, multiplied with the present value factor, it comes to 15.4098. okay, and here we have positive, that is contractual receipt given by the government of additional 2000 million rupees. So we have 2000 million divided by the third year factor of 113.67. okay, 113.67. so it comes to 17.5948 million multiplied with the factor of third year 0.658. It's a inflow of present value of the cash flow is 11.5773. okay, on which you are going to subtract the initial payment. okay, you are going to subtract the initial payment. So since all these are present values, since we are trying to find a NPV, so less investment, which is on present value terms, we have found it out to be 23.1492. so 23.1492 million. So when we net this out, okay, this is what we can call is the net present value. And if we do this netting, that is outflow in the form of investment, initial investment, and in the form of bank charges, and netting it with all the inflows in the form of annual fees, contractual receipts of swap and all, we get a positive NPV of 4.3289 million pounds sterling. So obviously, since you see that it's a positive NPV, so you will accept the proposal invitation to go for a swap. Okay, so such type of application questions have come in past, and the more you'll practice, the more you'll see the practice set of questions and the faculty notes, you'll become more comfortable, okay, using such situations, okay, understanding such situations to be able to solve them out. Okay, so this is what is there in this topic. So in this topic, when we see, which is basically foreign exchange derivatives in the form of products as forward, futures, options, and currency swaps, the most important frequent asked questions, as I said, this topic is important in the sense that you normally for sure get questions from this topic. At times in past, all this frequent asked situation question has come as a concept question, so you could be asked to explain the term foreign exchange risk. Okay, what is it? So we are talking of risk to be uncertainty due to fluctuation in foreign exchange rates. And so talking of those, the scenarios that probably could lead up to foreign exchange rate to fluctuate. Short notes have been asked on forward as a hedge instrument. Okay, how forward can be used to protect your risk. Okay, and we broadly have understood that how one can go about understanding and solving situations for hedging. Hedging is basically a process of minimizing, negating your risk, and which is nothing but trying to take a position similar to what you could have done, but not in spot market, but in derivatives market. Okay, and you have been asked in past to explain the term exposure netting. Okay, which is one of the best hedging mechanism for firms which is dealing with foreign currency inflows and outflows. So if you already have obligations of paying and receiving, you can net those exposures and minimize such kind of a risk by maintaining adequate balances in different currencies in different accounts, different places basically. And then you have been asked to even explain some rollover contracts. As I said, that predominantly forward contracts on rollover has been asked as concept questions. So you could be asked like cross currency rollover contract, what is those? We understood that rollover contracts are basically taking a forward contract for the entire sum, but then meeting an obligation, rolling over the obligation of installment payment on a given due dates. Okay, and that is how you keep on rolling over. Okay, one installment payment and second fixing a rate for installment payment on a given due date. And most frequently the concept question, the frequently asked question that has popped up from this topic is to write short notes on financial swaps. Okay, precisely for this topic we can say currency swaps, but then it could be financial swaps wherein you can discuss apart from currency swaps, interest rate swaps and all that we have already introduced in our chapter on derivatives. Okay, so very important topic in the sense that for your preparation from point of view, from this chapter you get a complete question, two questions basically, so which normally would mean a complete set of 15-16 marks, which could be a mix and match, but then from this topic you would definitely get a question. Okay, out of the two, one would be from this topic. Okay, so that is what makes this topic to be important. Okay, so understand it and you should be in a position to solve them all.